Good morning, traders. So I wanted to take a minute to go through this particular trade. This is the broken wing butterfly trade, and this is the one that expired on September 20th that closed out during the big down move last week, closed out for some nice profit. And I want to kind of walk through that here. So this trade was opened on July 19th. And for the first few days, there really, first 2 weeks really, there just really wasn't much, that happened with the trade. At one point, our market finally on July 24th started dropping. So when that started dropping, the standard move, or one of the standard moves, depending on where you're at in the trade, is to drop the right wing, flattening out your deltas. You see we go from a positive 7.2 delta to basically delta neutral. Also increase the theta in this process. And in this case, I did this by adding a second butterfly. Volatility was up. When volatility is up, it's cheaper to get into butterflies. So that's why this was a perfect opportunity to add to this trade. Now, my expectation, quite frankly, at the time was that we were probably going to bounce a little bit, but I was prepared either way. By adding this, flattening my deltas, increasing my theta, that was a good scenario for this particular trade. So I added that second butterfly, then I'm in this position. We sat there, just sort of chopped sideways again for a few days. Market starts to bounce around, goes below the tent, above the tent. But again, no real concerns here. Everything's moving along kind of as I would expect and hope. Then as we get to here on July 31st, market moved up. So I raised the right wing, again, kind of standard operating procedure. And then the very next day, so this goes against me, this plays against that move I just made. The very next day, this market dropped considerably. And when I say it plays against me, notice this is still a dashed line. I was not filled on this order, but I had an order out there waiting to raise this right wing. So that's an order that the GTC order just sets there and waits for that to fill. Now, at this point, it's unlikely that that particular order was going to fill. The next day, we sold off considerably, and I want you to see that before I adjusted, this thing had nice profitability in it, about $1,600 in profit. Now, that's not what you would have expected. Let me go back a day earlier here. That's not what you would have expected out of this move. Under normal circumstances, in that sell-off, you would expect to be down a little bit based on this particular structure. However, volatility spiked so much, and it spiked up more in some of the long options than it did in the short options. And that doesn't happen often at all, but it can happen in extreme volatility moves. And so what happened was some of the options that I was long were being sought after, and people were chasing those more than they were chasing these ones that I was short, probably because these were a little closer to the money, and therefore they were just getting bid up. So I should point out here that how I knew about this was I had this one order that was just floating out there, this particular order right here, and that order actually hit that next morning. I would not, again, expected it to have hit, but it did, and that was a signal to me that, something good for this particular trade is happening in this sell-off. That then gave me the opportunity to come in and look at the pricing on this additional adjustment and basically add to this trade to improve the situation of the trade in this downside move. Now, the other thing that was happening at this same time is the bid-ask spreads, which might normally be 50 cents wide, 75 cents wide. The bid-ask spreads were hitting $4, $5, $6 wide at this point. Now, in that scenario, you never, ever, ever want to do a market order, but I would float an order out there like this Condor order that I would consider to be favorably priced. Now, how I consider that price is I look at that order, I see this wide range that order is bouncing around in, and I kind of go toward the mid of that order and then go a little bit higher than the mid, or go a little more favorable to me in that mid. Depends on whether I'm buying or selling this particular piece, if you will. But I go a little more favorable to me on that mid. And I leave that order set there. And invariably, in these wide swinging markets, there's enough panic, there's enough people that are just looking to get into a position or out of a position that they don't care. So ultimately, I stand a chance of getting hit with a favorable fill, which is what happened here. So now I'm set up here in this particular position, which I like, because if the market continues further south here, this trade is only going to improve because I'm negative delta. If the market rockets up here, while it looks like it might be not so favorable to me, if the market moves up, we're going to have a release in volatility. That release in volatility is going to allow that line to raise up, bringing profitability into the trade. So I really had two ways of getting profitability into this trade now: an additional sell-off, or the market stabilizes here or rises a little, and then we get some release in the pressure, which would bring profitability back in. That's why butterflies in some of these trades are so good to get into when volatility is high, because once you do get a volatility release, you have a higher level of profit. So that's kind of what happened here. The market started to stabilize a little bit and seemed to be okay, but then we had that massive gap down the next day. So that massive gap down, we can see here that my T0 lines are all over the board. Obviously, I was not up $16,000 in this position, but I looked at yet another trade here to take advantage of that volatility and reduce my risk to the downside, again, if I got a fill. But I had to go out there on that order, and I looked at where it was trading, and then I chose a price that was just a little more favorable to me than the mid, and let that set there, and sure enough, that got filled. So I'm now in this position on August 5th. The market continued moving down that day. I then basically took a bunch of that lower structure off, closing out much of that trade. That whole condor piece I closed out, basically making sure that I've locked in about $3,100 in profit on this trade, no matter how low the market goes at this point. Now, if the market were to rip back up from 51.73 all the way up here to 55.34, I could start to potentially get back into loss territory. But I wasn't overly concerned about that at that time. So I just let that trade sit there for a day or two and let it stew. I did have this GTC order out there to fully close that trade. I believe we're trading at 940 there. I'm pretty sure I had that order out there at $10. So I just kind of sat and waited 2-3 days. Didn't hit yet on the 6th, didn't hit yet on the 7th. And then on the 8th, it finally hit, essentially locking in 31% profit, about $3,200. And again, the goal here is to show that sometimes in these wild markets, in fact, I should let me just pull in a chart here of the VIX. Sometimes when you have those sorts of situations where the market just does really unexpected stuff, options prices can be more favorable than you think. And that's what happened right here. You can see how crazy VIX got. Now, to put that in perspective, that was the third largest move, I later read in the news, the third largest move ever in VIX. I don't remember exactly where the first one was, but the second one, or actually this was the worst or the highest move in VIX. This was during COVID. And if you remember, in COVID, the world was essentially coming to an end. I mean, nobody knew what was going to happen. We were in uncharted territory. And I kind of understand volatility being up at 84 or so in that environment. This move on Monday, where we're up at 65 VIX, that did not make any logical sense to me. At the point that was happening, I'm thinking in my mind there's something big going on behind the scenes here that we don't yet know about. Something like in 2008 with the Lehman Brothers collapse. something big like that was what I was thinking was going on. At this point, nothing has revealed itself, and obviously volatility is way back down now. So I think we're out of the woods, at least on whatever spiked VIX so much here. And I know it had something to do with Japan and what they call a carry trade. Not going to go into all that. But that seemed to be what sort of spiked that. But again, the whole point being here, two things. One, in extreme market conditions, options don't always act the way that modeling shows they're going to act. That's number one. Number two, the fact that I had a GTC order setting out there to get a favorable fill on something actually triggered me to look at this trade. Otherwise, in my mind, I would have been thinking, oh, big down day. I know what's going to happen on that butterfly. We're going to blow out the bottom side of the tent, and we're not going to have the profitability that I want. That's probably going to be showing some loss. That's what you might normally expect in that environment. But the fact that I had that GTC order that fired off made me go look at that trade, and that's when I saw that, oh, this unusual options volatility has spiked the right options prices in this trade, allowing me to take advantage of the situation. So that's the big takeaway here. Just wanted to share that with everyone. It's a very rare instance. Again, this was the third highest VIX reading on record, so this is not something that's going to happen very often, but just little tips to look for those anomalies when they happen. So hopefully this helps a little bit.